The ultimate goal for most investors is reaching a point where your portfolio functions like a machine, generating constant mechanical cash flow to live on, without ever forcing you to sell off your underlying assets. Recently, a hypothetical 5 ETF portfolio has been circulating, built specifically around the claim of generating $8,000 a month in portfolio income. If we run the numbers on current yields, blending them equally gets you between 12 and 13.1%. At the high end of that band, to hit $96,000 a year, your $8,000 a month, you need a capital base of roughly $733,000. Even if yields compress closer to 12%, you're still looking at an $800,000 requirement. This table compares the capital requirement of different approaches. On the left, a standard dividend strategy yielding 3% requires over $3 million. On the right, this derivative income system brings the requirement down to $750,000. The arithmetic holds up, but traditional markets do not offer 13% yields without a catch. Hitting that number requires stepping outside standard asset allocation and altering the underlying rules of risk and reward. A double-digit yield is never a free lunch or a magic dividend. It is a highly engineered trade-off. The engine driving this portfolio is a series of derivative overlays. By actively selling options contracts on the underlying indexes, these funds capture market volatility and immediately convert it into premium income. But extracting that much immediate cash has a direct, undeniable cost. Premium income strategies cap how much you can participate in strong market rallies. You are explicitly giving up long-term capital appreciation and the power of compound growth in exchange for immediate spendable dollars today. This portfolio functions as a mechanical system designed to systematically trade potential future wealth for current spendable income. Let's examine the first layer of this system, the large-cap tech and growth anchors. We have two funds tracking the NASDAQ 100, TDAC and GPIQ. To evaluate these funds, we need to map this out on a chart, comparing the current yield on the vertical axis against the bull market upside on the horizontal axis. Every ETF in this portfolio earns its place based on how much upside it sacrifices for its yield. First is TDAC. Each morning, it sells 0 days to expiration options on the NASDAQ 100, capturing the option's rapid loss in value, known as theta decay, as the trading session progresses. That aggressive daily selling generates a massive trailing yield of around 17%. The cost is severe. On days the NASDAQ surges upward, TDAC will heavily lag the underlying index. If you build a portfolio entirely out of funds like that, you risk long-term capital erosion. That is why GPIQ is included as a deliberate counterweight. GPIQ tracks the exact same index, but uses a dynamic options overlay. Instead of selling calls against the entire position, it writes options on somewhere between 25 and 75. But instead of selling covered calls, it sells put credit spreads on one DEX. This structure generates income while creating a defined floor to cap immediate downside risk. Because it uses a put spread instead of a covered call, the upside remains uncapped. You capture the S&P 500's growth alongside a 10% yield, which justifies the fund's slightly higher expense ratio. Then we have IWMI. This is the only position in the portfolio that provides exposure to small-cap stocks, tracking the Russell 2000. Small-cap stocks operate with a higher baseline of volatility, but they tend to outperform during early economic recovery cycles. They prevent the portfolio from being entirely reliant on the performance of megatech tech. Beyond diversification, these funds share a specific tax reality. Because they generate income using broad index options, the gains qualify as Section 1256 contracts. The IRS taxes those gains at a blended rate, 60% long-term and 40% short-term, regardless of how long the fund held the options. For high-income earners in top tax brackets, this structure acts as a highly efficient tax shield. The final position in the system moves away from broad equities entirely. This is MLPI, an energy infrastructure fund. It holds master limited partnerships that operate midstream pipelines and processing terminals. These are fee-based businesses that charge for throughput, creating predictable cash flows that largely ignore the daily fluctuations in oil prices. Looking back at our chart, MLPI takes those physical assets and applies an options overlay, pushing the overall yield up into the 14 to 15% range. But the real structural advantage here is administrative. Direct ownership of MLPs requires filing complex K-1 tax forms every spring. MLPI wraps those assets into an ETF structure, issuing a standard 1099 form instead. Allocating a full 20% of a portfolio to the energy sector is heavy concentration. Here, it earns its spot by delivering a non-correlated income stream while actively eliminating an administrative nightmare come tax season. Now we bring the pieces together. Every dollar in this portfolio is deployed evenly, allocating 20% to each of the 5 funds. This chart shows the equal weight distribution, resulting in a 13.1% blended yield. This structure is deliberate. It prevents the temptation to blindly overload into a single asset just to chase its 17% payout. Keep in mind that 13.1% is not a fixed guaranteed rate. It is a functional band that will expand or contract based on current market volatility and the pricing of option premiums. And because every dollar is deployed directly into this income layer without a dedicated cash bucket, the total principal value of your $800,000 remains fully exposed to market fluctuations. Hitting that $8,000 monthly target requires a balanced system where each position handles a specific task, whether that is maximizing income, retaining upside, or providing tax efficiency. The mechanics work. But that leaves the final decision. Is an engineered yield actually the right fit for your current financial phase? Here's the decision matrix. If you are a younger investor in your accumulation phase with decades ahead of you, this system is a poor fit. These strategies actively drag on your total return. Over a 20-year timeline, a pure, uncapped index fund will mathematically outperform this portfolio by allowing your capital to compound without interruption. However, if you are a retiree or a high net worth investor actively looking to extract cash, the math changes completely. In the distribution phase, you need high monthly cash flow to replace a salary without being forced to sell shares during market downturns. The combination of high baseline yield and Section 1256 tax efficiency makes this a highly functional tool. You can secure a double-digit yield, but do not chase it blindly. Build this portfolio only if you fully respect the structural trade-off. You are trading tomorrow's market rallies for today's hard cash.